There is a moment in your financial life when everything begins to shift, but it doesn't announce itself. And it definitely doesn't look dramatic from the outside. It feels more like a quiet disturbance in the numbers, a subtle acceleration that you only notice if you're paying close attention. Wealth doesn't start with your first paycheck, your first investment, or even your first $10,000. It starts the moment your financial behavior activates a mechanism the banking system would prefer you never discover, the hidden wealth trigger. Not a product, not a fund, not a hack, a behavior pattern that transforms the entire trajectory of your net worth once you cross a certain threshold. My name is Dave, and this is Dave's Dividend Lab. I make long form deep dives into the psychology, math, and quiet mechanics of wealth, explaining the parts of personal finance that almost no one talks about because they don't fit neatly into a quick TikTok clip or a one-page blog post. If that's the kind of breakdown you've been searching for, hit subscribe, tap like, and drop a quick comment telling me where you are on your investing journey. Because today, we're going to uncover a financial shift that quietly separates lifelong savers from lifelong wealth builders. Most people imagine wealth as something that grows evenly: save a little, invest a little, watch it rise over time. But that's not how the system works. Not mathematically, not psychologically, and definitely not structurally. The early years feel slow because every dollar is fighting friction, inflation, volatility, fees, uncertainty, and your own inconsistent habits. But once you cross a very specific behavioral threshold, one that the wealthy understand instinctively, you activate exponential momentum. It's the point where your money no longer depends on discipline alone. Your systems begin doing the heavy lifting. Banks don't talk about this trigger because the entire consumer finance industry thrives on one assumption: that the average person will always operate in short-term cycles. They expect you to react emotionally, to spend impulsively, to save inconsistently, and to treat money as something that serves the present rather than something that builds the future. The system is designed around that expectation. But when someone breaks out of that pattern, when someone invests automatically, consistently, and without emotional interruption, that person stops behaving like a consumer and starts behaving like capital. And that's where the hidden trigger lives. It isn't the size of your income, it isn't the size of your portfolio. It's the moment your money behaves the same on your worst days as it does on your best ones. The moment your behavior stops fluctuating. The moment your financial decisions become independent of motivation, mood, fear, or excitement. Wealth accelerates when it becomes boring, predictable, repetitive, automated. That's the shift banks don't want you to recognize. The point where your money stops relying on your emotions and starts relying on your systems. Once this trigger flips, everything in your financial life starts compounding more predictably and more rapidly than you expect. Your net worth stops reacting to your income and starts reacting to time. And time, if you stay consistent, has far more force than any paycheck ever could. In the next part, we'll break down the mechanism behind this trigger, what exactly changes in your financial life, why your returns start accelerating, and what banks have quietly known about this pattern for decades. The hidden wealth trigger doesn't activate when you hit a certain dollar amount. It activates when you cross a behavioral threshold, one that almost no traditional financial institution expects you to reach. Banks model the average customer as someone who saves inconsistently, invests sporadically, panics during downturns, and thinks in 12-month increments. The entire consumer finance industry is built around these assumptions: that emotions will override logic, that discipline will break under pressure, and that habits will collapse when motivation fades. But the moment you stop acting like the statistical consumer and start behaving like long-term capital, the models break and wealth begins to accelerate. The first sign that you've crossed the threshold is subtle. Your financial decisions stop negotiating with your emotions. You no longer feel like investing. You do it automatically. You no longer wait for the perfect moment to buy. You follow your plan. You no longer react to red weeks. You stay the course. And once that emotional noise disappears, your money stops living in short-term cycles and begins operating on long-term timelines. This is the shift institutions never prepare you for. Because most people don't get here, not because they're incapable, but because they never stay invested long enough to reach the part of the curve where behavior becomes more important than strategy. The early years of investing disguise this truth. When your portfolio is small, your behavior barely affects the outcome. You can skip a month, panic sell a position, chase a trend, or jump between strategies, and the consequences feel minor. But once your portfolio grows, every behavioral error is amplified. Every emotional decision slows momentum. Every moment of inconsistency pushes you further from long term acceleration. And that's why banks don't talk about the hidden trigger, because they assume you'll never reach it. But what they underestimate is the compounding effect of consistent behavior. The longer you stay the course, the more your habits begin shaping the growth of your wealth. You go from reacting to the market to anticipating it. You go from checking your portfolio daily to checking your contribution schedule monthly. Your thinking shifts from what happened today to what will this look like in 10 years. And that mental shift begins redefining the physics of your net worth. When your systems remain stable through boredom, through downturns, through noise, you break free from the pattern that keeps most people stuck in financial stagnation. This is when your deposits begin landing on fertile ground instead of on fragile soil. Every dollar stays invested longer. Every fluctuation compounds into something meaningful. Every habit builds a thicker foundation. It's at this stage that investors often notice something strange. Their net worth starts rising even on months when they didn't do anything extraordinary. Their portfolio moves by hundreds, then thousands, simply because the base became heavy enough and their behavior became stable enough. That's the hidden trigger in motion. Behavior becomes momentum. Momentum becomes compounding. Compounding becomes acceleration. And once acceleration starts, your net worth begins responding differently to time, risk, and opportunity. It becomes less a reflection of your income and more a reflection of your consistency. In the next part, we'll break down the mathematical engine behind the trigger. What actually happens to your returns, your contribution to growth ratio, and the slope of your wealth curve once this behavioral shift becomes permanent. The moment your behavior stabilizes, the math of your wealth shifts in a way that feels almost invisible at first. You don't suddenly earn more. You don't stumble into a lucky stock. You don't change your lifestyle. What changes is the ratio, the balance between what you contribute and what your portfolio contributes. This ratio is the engine behind the hidden wealth trigger. It is the silent calculation banks hope you never stay invested long enough to uncover. In the early years, the numbers are brutally simple. 90% of your portfolio comes from your deposits. Market growth adds a little, but it can't overcome the small base. A 7% return on $5,000 is $350. A good month feels like noise. That's why early investors quit. They mistake small returns for broken math, but the math isn't broken. It's just waiting for your base to reach critical mass. The tipping point comes the moment your annual market growth equals or surpasses your yearly contributions. It doesn't need to happen every month. It only needs to happen consistently enough to tilt the slope of your long-term curve. And once it does, the shape of your financial life changes permanently. Let's take a simple example. If you invest $500 a month, $6,000 per year, the hidden trigger activates once your portfolio reliably produces $6,000, $7,000 a year in returns. That happens somewhere in the $85,000 to $110,000 range with normal market conditions. That's the moment your portfolio becomes a second income stream, not an expense. It's the moment your wealth starts carrying itself. Here's the part most people never understand. Once your returns match your contributions, every additional dollar of growth accelerates the curve. The engine begins compounding, not from your effort, but from its own momentum. And this is where the math becomes exponential. The growth to contribution ratio flips. Your deposits no longer dominate your balance, your returns do. In year one, your money grows because you put money in. By year 7 or 8, your money grows because it's been invested long enough. This shift has a powerful psychological effect. You stop seeing the market as something you're trying to beat. You start seeing it as a machine that reliably multiplies consistent behavior. And this is also where banks lose their advantage. Banks expect you to quit at the flat part of the curve, the part where they profit from your short term mindset. They expect your savings account to sit idle. They expect you to chase trends, panic during downturns, and interrupt compounding before it matures. That's why they never talk about the moment when returns outgrow income. It's the point where you no longer rely on their products. You rely on your own compounding engine. Once the trigger flips, the numbers begin responding to time differently. A 7% return on $120,000 is $8,400. A 7% return on $200,000 is $14,000. On $350,000, it's $24,500. On $500,000, it's $35,000. And none of those jumps require you to increase your savings rate. They simply require you to stay. This is the hidden power curve, the one that finally bends upward the moment your base becomes large enough and your behavior becomes consistent enough. It's not a secret formula. It's not a loophole. It's the mathematical reward for doing something most people never do, not quitting during the slow years. In the next part, we'll look at how the trigger reshapes your psychology, why motivation stops mattering, and why investors who reach this phase never go back to their old financial habits. When the hidden wealth trigger activates, the most dramatic change doesn't happen on your spreadsheet. It happens in your mind. Not instantly, not with fireworks. It happens quietly, like a background process that runs without you noticing. One day, you look at your portfolio and something feels different. You're not checking it compulsively. You're not reacting to every dip. You're not chasing every high. You've crossed a mental threshold most people never reach. The moment wealth stops being emotional and starts becoming structural. This is the psychological transformation that banks never factor into their assumptions. They expect you to stay fearful. They expect you to remain short term. They expect your discipline to collapse when motivation fades. But once the hidden trigger flips, your thinking disconnects from the consumer mindset entirely. You stop worrying about bad weeks because you've lived through enough of them to understand they don't matter. You stop celebrating good weeks because you know they're temporary. Your emotions flatten out. The noise disappears. You begin to experience the market the way institutions do, as a long, slow, powerful engine that rewards consistency and punishes reaction. This is the point where most long-term investors describe feeling a strange sense of calm, not because their lives became easier or their income suddenly exploded, but because uncertainty stops controlling their decisions. Fear becomes data. Volatility becomes routine. Time becomes an ally instead of a threat. You start measuring progress in years, not days. You judge decisions by long-term effect, not short-term gratification, and you stop comparing your progress to everyone else's. Emotionally, this stage is liberating, not because you made it, but because you finally understand the game. You also begin reevaluating your relationship with money. You realize that wealth is not built by chasing extraordinary events. It's built by repeating ordinary behaviors for an extraordinary amount of time. You realize that the early grind wasn't pointless. It was foundational. You realize that discipline is not a trait, it's a pattern. And once a pattern stabilizes, it becomes almost impossible to break. The most powerful psychological shift is this: you stop treating investing as something you should do and start treating it as something you simply are. The same way you brush your teeth or drink water, without debate, without motivation, without negotiation. It's just what you do. This identity shift is the secret advantage long-term investors hold over everyone else. They don't need discipline anymore because their habits have hardened into identity. They invest on autopilot. They ignore noise instinctively. They stay the course without emotional friction. And that mental freedom opens the door to the next stage of the wealth curve, the phase where opportunities begin emerging instead of being forced. Because once your behavior stabilizes and your returns outpace your contributions, the way you see risk changes. You stop fearing loss and start understanding probability. You stop trying to time events and start preparing for cycles. You stop reacting to the present and start positioning for the future. At this stage, your net worth is no longer something you chase. It's something that unfolds. Consistency becomes leverage, time becomes acceleration, and opportunities appear because you finally have the mental space to recognize them. In the next part, we'll break down the final transformation, what happens when the hidden trigger fully matures, how your net worth behaves once momentum becomes self-sustaining, and why this phase feels least like effort and more like gravity pulling you upward. When the hidden wealth trigger matures, the experience is unlike anything you felt in the early years. Nothing explodes, nothing suddenly doubles overnight. Instead, your financial life begins moving with a quiet force that feels almost effortless, as if gravity has reversed direction and started working for you instead of against you. This stage is where long term compounding becomes unmistakable, not as a theory or a promise, but as a lived reality. The first sign is the pace. Your portfolio stops responding to the size of your deposits and starts responding to the size of your base. A single year of market growth can match 6 months of contributions. In a strong year, it can exceed an entire year's deposits. This is where the math becomes emotional, not because the numbers are big, but because they move without your constant input. The second sign is the sense of independence. You no longer rely solely on your paycheck to advance your financial life. Your money accelerates on its own. You start seeing your net worth jump by amounts that once required major effort. A few percentage points in a month feel like a raise. A strong quarter feels like a bonus you didn't request. You begin to understand why wealthy people behave differently, because their portfolios, not their labor, do the heavy lifting. The third sign is psychological detachment, not from your goals, but from the noise. You stop reacting to volatility because you've seen the cycles play out enough times to know how they resolve. You stop chasing high returns because you understand that stability compounds faster than excitement. You stop thinking in terms of wins and losses and start thinking in terms of trajectory. The daily fluctuations become background detail. The long-term slope becomes the story. This is where a deeper realization emerges. Wealth isn't an event. It's a shift in physics. In the early stages, you were dragging your portfolio uphill. Now the hill leans forward and you're walking with gravity. Momentum takes over. Small decisions matter more. Mistakes matter less. Time amplifies your discipline, not your errors. Even downturns serve a purpose. They accelerate future growth by giving you cheaper entry points while your system continues operating. The fourth sign is that opportunities finally start showing up. Not because the world changed, but because you did. You have liquidity. You have stability. You have optionality, the currency the wealthy value more than anything else. Suddenly, you can take advantage of market dips instead of fearing them. You can invest aggressively when others hesitate. You can plan years ahead instead of reacting to every headline. At this stage, banks are no longer part of the conversation. Their models assumed you'd never reach this point. Their expectations relied on your inconsistency, but consistency became your advantage. And now the returns they expected you to interrupt have become the engine driving you forward. The final transformation of the hidden wealth trigger is understanding that wealth is not a reward for high income. It's a reward for long-term behavior that compounds long after the motivation disappears. You've crossed into the phase where your net worth grows because you built systems that outlast your mood, your fears, and your circumstances. This is the moment every investor is chasing, even if they don't have words for it. The point where your money wakes up, stands on its own, and begins writing a future you no longer have to fight for.